All right, so in Chapter 8, we get into individual tax computation and tax credits. So we'll talk quite a bit about credits for sure in this chapter. And I'm going to look at one of the problems at the back of the book and just kind of talk to you a little bit in general about the terminology and how to handle some of the different items that you'll come across as you work through these. And so this one I'm looking at is a married couple. They have a 7-year-old daughter. Oops. And John works at a local university. He has a salary, and Sandy works part-time as a receptionist and also has a salary. And then John has a side job. He's got revenues of $4,000 and associated expenses of $750. They have $800 in qualified dividends. So I guess I should be putting this in here. Salary of $152, and then we'll talk about where these go and how they're included. Salary of $29. Web design, revenue of $4,000, and expenses of $750. $800 in qualified dividends, and a $200 state tax refund. They itemize, and it says last year they were well over the standard, which we'll need to know for our state refund taxability. And it does tell us that they had qualifying insurance for purposes of the Affordable Care Act, and so we can make a note of that as well. Okay, so we'll jump right into this. It says that they made the following payments, and so we have state income taxes, federal tax withholding, alimony payments from a divorce in 2014, child support, $12,200 of real property taxes. Sandy got reimbursed for some employee business expenses, $3,600 to kid daycare, $14,000 interest on home mortgage, $3,000 interest on a $40,000 home equity loan. They used the loan to pay for a vacation and a new car. $15,000 in cash charitable contributions, and then donation of used furniture to Goodwill. So, very common information that you'll find. And so what we're going to do, it asks us in the problem to calculate income tax payable or refund. And so we're going to start with the salary. Well, actually, what we're going to start with is gross income. And then we'll start with the salary. We know that we have that. It's $181, the two added together. That's the way it's going to show up on the 1040. We have self-employment revenue of $4,000. And we have dividends of $800. And then our state income tax refund, they did itemized last year, and it said they were well over, and so we'll include that in their gross income. And so all of those added together will give us their total gross income, or $186,000. And now we can do our 4 AGI deductions. And if you want, you can follow along on our 1040. That's a good place to look. So we have self-employment deductions, which is $750. We have the employer portion of the self-employment tax, and if you remember, that is our self-employment income, which is $3,250. The $4,000 minus the $750 times 0.9235 times 1.45. And the reason that is 1.45, I had to look at my notes. Now I've got to go find my notes. I have a note here to look at my notes. I just have to find them. Okay, so John is over the wage base limit, and $132,900 is the wage base limit for Social Security. So he only owes the 2.9%. And since that's all he owes, it's the 1.45. And we'll look at that again when we calculate his self-employment. I'll probably explain that a little bit better when we get to that. But for now, this is $44. Okay, and then we have alimony. And this is, again, we have to look at the date of the divorce. So he's got alimony deduction, which is again a 4 AGI. And that should take care of all of that. And so then we have our AGI, adjusted gross income. And that is our gross income minus the sum of our 4 AGI. And so 185,206. Oh, I missed that 10,000. Hang on. There we go. 175. 206, and then we do our itemized deductions. And we'll talk about these as we go along. So taxes, you get to itemize. However, it is limited to $10,000. So we have state income taxes of $4,400 plus real property tax of $12,200, but it's limited to $10,000. And this really hurt a lot of people last year on their itemized deductions. Home mortgage interest is $14,000. The home equity is not allowed. Remember what they use that money for. And then our charitable contributions, it's not limited, so it's $15,000 for the cash. And the charitable donation of furniture is the lesser of the fair market value or the basis, and the fair market value is $400. And so our total itemized, we add these together to make sure that we have, and we compare it to standard. And so we see that definitely their standard is lower. Standard's 24.4, so they'll be taking their itemized deductions. They also get a deduction for QBI, qualified business income, which is 20% of, and I'm going to show this here, it's the 4,000 minus 750 minus the 44. So there's a calculation for QBI, and then we multiply that by 20%. And so that is $641. And so that gives us our taxable income. The way we calculate that is we take our AGI minus our standard itemized, and then minus our QBI deduction. And I don't think, yeah, it didn't take that. Minus F22. There we go. 135, 165, and then we go calculate our tax. Whoops. Using tax on my keyboard. There we go. We go calculate tax using our tax rate schedules. And so we're going to go to the married filing joint tax rate schedule. And we have to calculate that, and we have to pull out those dividends. So we take this 135, oh wait, let me do it over here. This is my notes. This 135, 165, take out the dividends, the $800 dividend before you calculate it. And that gives you 134, 365, and you calculate the tax on that using your tax rate schedules, and you should come up with 21,277. And then we have the tax on dividends, and they're qualified. It told us that. So that's the 800 times 15%. So $120 is the tax on that. So we have total federal income tax, and that is our tax plus our qualified dividend tax. It does not like it when I do that. There we go. $21,397. And then we have our self-employment tax. Now this is, I'm going to talk about this a little bit more here. So the self-employment tax, that's our $4,000 minus our $750. Okay, remember yeah, it's right here. And then we multiply that. So if you were calculating this, you would have to put brackets around it. I'm just showing you the calculation at this point. We multiply that by 0.9235, and then normally it would be times 15.3%, which is Social Security and Medicare. However, he has met his Social Security limit with his income, and so he doesn't owe Social Security, so it's only going to be the 2.9% is his self-employment tax. And so that's going to be $87. And alternative minimum tax, I will just tell you is 0. We'll talk more about that later. And taxes then are the sum of his federal income tax, his self-employment tax, and his alternative minimum tax. Then he's got a credit, child and dependent care credit. Of $600. Now what they told us, and go back to the problem, on go way back to the problem. Here we go. It told us that $3,600 to Kid Care Daycare Center for Samantha's care while John and Sandy work. It's important that you know that it has to be while they work. And so the child and dependent care expenditures, $3,600. The limit on qualifying expenditures for one child is $3,000. And so they're under the limit, so we're okay there. And so they get to take 20% of that limit, or $600. That's how we calculate that. And then we have their child tax credit. And again, they're under the limit. They're okay there, so that's $2,000. And then we have their federal tax withholding, and that was given to us. It was $21,000. And so from that, we come up with tax due or refund. And so their tax is $21,844 minus their child care credit, minus their child credit. I need to go back and change that. Minus their federal withholding. Hold on. Okay, so they have a refund. This should say not child credit, but child credit, not child care. There we go. They have a refund of $2,116. So the alternative minimum tax, just real briefly want to kind of talk about this. It's something that a lot of people just don't talk about. But there's a formula for that. And so you take your taxable amount, which is $135,165, and then you add adjustments. And so one of the adjustments we add are taxes that we deducted of $10,000. It was over here in our itemized. And again, it's just a formula. And then we subtract a state income tax refund. If it was added in, we subtracted, and it was. So we're going to take that out. And that gives us our AMT taxable income. Now, there are other adjustments, but for this particular problem, those are the adjustments that we have. So that gives us $144,965. And then we have what's called an AMT exemption. And that one is married filing joint 2019 exemption amount is $111,700. And that gives us what we call our AMT base, which is the taxable income minus the exemption, $33,625. And then we have we take line 6, the base, minus our dividends, times 26% plus the dividend tax, and we come up with $8,561. And I'll show you that formula over here. That is our $33,265, and I'm just following a formula in the book. So, and you take out those dividends, and then you multiply it by 26%, and then you add back the dividend tax, the 15%. Okay, then we have regular tax, which we had calculated of $21,397, and that tells us that our AMT is 0 because this number is bigger than this number. Okay, so again, it's a formula in the book. If you have good software, it does this for you. But again, as I said a million times, you have to be able to go back and check this. And so go into the book, make sure you understand how we did this calculation. It's very easy. It's just following the guidelines given to you.